The empire that now programs the entire world started on a Bullock cart and ended up fabricating frauds worth billions of dollars. This is how India's real tech bubble was born. 1985, a dusty street in Bangalore. A wooden cart. On top of it, Texas Instruments hauled the country's first private satellite dish to connect with the United States. Welcome to Plexo. Before it became Asia's Silicon Valley, Bangalore was a city of retirees and state-owned factories. But the Indian government was desperate to attract foreign capital. The arrival of that giant dish, dragged by animals through bicycles, proved something revolutionary. Indian engineers could write code in Asia and beam it to North America in real time. 4 years earlier, in 1981, another quiet miracle had happened. Narayana Murthy, an engineer with thick glasses and a stern gaze, borrowed $250 from his wife Sudha. With that money, he founded Infosys. Murthy understood that India had an unbeatable advantage. It produced thousands of brilliant engineers willing to work for a fraction of Western salaries. By the 1990s, the government liberalized the economy. Tech companies grew without state control. Bangalore filled with cranes, fiber optic cables, and glass buildings. Global corporations discovered they could outsource their software development, drastically cutting operating costs. The seed of monopoly was planted. The world was about to go digital, and India would be its engine room. What no one calculated then was that this engine room could also catch fire from the inside. The great catalyst of this industrial revolution wasn't a brilliant innovation, it was a programming error. In the late 1990s, the Western world panicked over the Y2K bug. Computer systems at banks, airlines, and governments were programmed with only 2 digits for the year. When the new millennium arrived, computers would interpret 2000 as 1900, threatening to paralyze the global economy. Fixing this bug required manually reviewing billions of lines of code. The United States and Europe didn't have enough programmers to do it in time. India did. Companies like Wipro, Tata Consultancy Services, and Infosys offered armies of Indian programmers, typing under fluorescent lights to prevent the Y2K collapse. They worked endless shifts in huge industrial sheds in Bangalore, earning a fraction of what their American counterparts made. This event injected billions of dollars into the Indian economy. Overnight, the IT sector went from marginal to the country's most powerful export engine. Young Indians no longer wanted to be doctors or lawyers. They wanted to study computer science. Technical universities multiplied their enrollments, creating a human assembly line that exported raw talent. Bangalore changed forever. Salaries rose. Traffic became chaotic. Upscale malls and luxury restaurants sprang up to cater to a new middle class enriched by code. The city got drunk on its own success. Money flowed like water. Complacency settled into boardrooms. An entire country mistook someone else's emergency for its own merit, and that confusion would come with a price. As revenues grew, so did the lies. Satyam Computer Services was India's 4th largest tech company, a giant listed on the New York Stock Exchange. Its founder, Raju Ramlinga Raju, a round-faced man with a perpetually calculating smile, was revered as an untouchable pioneer. But behind the corporate governance awards, Raju was running a monumental scam. For years, Satyam reported record profits and spectacular operating margins. The reality was much darker. The company simply invented its revenue. Raju faked bank statements to show about $1.04 billion in cash that didn't exist. The scheme worked as long as the economy grew, because nobody questions a winner. Then, in 2008, the global financial crisis dried up capital. Cornered by his own lies, Raju tried to use Satyam's money to buy real estate companies controlled by his own family. He wanted to replace fake assets with real properties. Alarmed investors dumped the stock. On January 7, 2009, Raju sent a confession letter to the board. He admitted that riding the tiger of fraud had become unsustainable. The impact was devastating. Satyam's stock collapsed 77% in a single day. On the streets of Hyderabad, furious investors burned corporate documents outside the company's offices. The scandal shattered the credibility of India's miracle. It proved that rapid growth had created a system without oversight, where auditors looked the other way while founders looted their own companies. Raju had built an empire of numbers that didn't exist. The irony, the auditors who signed off on those balance sheets collected their fees until the very end. After Satyam's collapse, India's tech sector reinvented itself. It no longer wanted to be just the cheap back office for the West. It wanted to build its own platforms. With the arrival of smartphones and cheap internet, a new generation of entrepreneurs flooded Bangalore. The unicorn era had begun. The crown jewel was Byju's, an edtech company founded in 2011 by Baiju Ravindran. Its business model seemed foolproof. It offered tutoring through a mobile app, promising to democratize education in a country obsessed with competitive exams. When the 2020 pandemic shut down schools, Byju's exploded. International venture capital funds poured billions into the company. By 2022, Byju's reached an astronomical valuation of $22 billion. It was India's most valuable startup. Money flowed without restraint. The company bought competitors at absurd prices, spent fortunes on marketing, and sponsored the national cricket team. Giant Byju's billboards lit up Bangalore's slums, selling a dream of academic success to lower-class families. The company's salespeople used aggressive tactics. They convinced cash-strapped parents to sign high-interest loans just to pay for subscriptions their kids barely used. The model wasn't based on education, it was based on debt. Investors applauded every new funding round, ignoring that the company spent far more than it earned. Every billboard was really an unbacked invoice. The bubble was inflating again, and this time it carried the names of millions of children as collateral. Gravity always wins. When schools reopened and global interest rates rose, easy money vanished. The funding winter hit Bangalore with unprecedented brutality. Foreign investors, suddenly cautious, demanded real profits instead of optimistic projections. Byju's collapsed under the weight of its own ambitions. The company couldn't pay the massive loans it had taken to finance its acquisitions. Auditors resigned, citing accounting irregularities. In 2024, financial giant HSBC published a devastating report. It valued the stake in Byju's at exactly $0. The founder himself publicly admitted the company was worth nothing. Empty startup offices, with Byju's logos ripped off glass walls, became Bangalore's new landscape. Thousands of employees were laid off, without notice. The collapse of the country's largest startup sent shockwaves through the entire Indian ecosystem. It wasn't an isolated case, but a symptom of a systemic disease. Bangalore's miracle was always built on labor arbitrage and cheap capital. From Texas Instruments' Bullock carts to billion-dollar education apps, India has been the perfect laboratory for tech speculation. They have the talent, ambition, and scale, but often lack the governance to sustain lasting empires. The cycle of greed and collapse has repeated from 1981 to 2024 with almost mathematical precision. Bangalore didn't digitize the world, it simply industrialized the exception, turning lack of scruples into the planet's most profitable operating system.